Hey everyone, happy Tuesday. Hope you had a fantastic long weekend celebrating Martin Luther King Jr. Day. This year, as you know, was extra special as it also coincided with Inauguration Day. But for now, let's dive into this week's market update and break down some critical developments in real estate, mortgages, and we'll look at some economic indicators. There's a lot happening, so stick with me. It is all connected. As you may know, President Donald Trump has tapped Bill Pulte, a private equity CEO and philanthropist, to lead the Federal Housing Finance Agency. If confirmed, he will oversee Fannie Mae and Freddie Mac, which you may know, they back roughly half of all U.S. residential mortgages. This administration is eyeing a plan to release these giants from government control, a move that could send shockwaves through the mortgage market. If you're in the industry, keep your eyes on this one. The ripple effect could be massive. According to the Mortgage Bankers Association, mortgage applications jumped about 33.33% last week after a holiday-related dip. This spike is a mix of refinance and purchase activity, likely tied to easing inflation concerns and market optimism. Translation: buyers and homeowners are re-engaging as rates hover at an encouraging rate. Now let's talk about the bond markets, which are setting the tone for those mortgage rates. The 10-year Treasury yield has dipped to about 4.57%, breaking through two critical technical levels: the 23.6% Fibonacci level and the 25-day moving average. If this trend holds, there's potential for yields to drop further, creating a 10 basis point decline, which could translate to a 40 basis point improvement in mortgage-backed securities. This is good news for rates, but we're not out of the woods yet. It all depends on these levels holding steady. What are two of the biggest drivers of mortgage rates? Inflation and jobs. Inflation might see some relief from lower oil prices. Projections suggest that oil could drop below $60 a barrel by 2027, which could lead to a $2.50 a gallon gas prices. Job growth does look strong on paper, but it's weak in breadth. Key sectors like healthcare and government have driven recent numbers, while other industries lag. This imbalance, along with the potential downward revisions, could signal weaker job data ahead, another factor that could ease rates. The housing market's pulse is coming on Friday with an existing home sales report, and for now, activity remains tied to affordability and inventory, with lower rates potentially drawing buyers back into the fold. As we kick off the week, optimism is building for both bonds and mortgage rates. If you're thinking of locking in a rate or making a move in the market, now's a great time to stay informed and act strategically. Well, that's all I have for you today. Until next time, remember, the market doesn't wait and neither should you. Stay proactive, stay informed, and let's make this year the best yet. Let me know what questions you have, and I'll catch you in next week's update.